Hi, this is Don Gooding with the 4 Colors of Money for Entrepreneurs. In this video, I'm going to talk about that very sensitive subject, valuation. And in particular, I'm going to be talking about the techniques that are used by equity investors to place a value on early stage, very high potential companies. The issue of valuing companies is common in many contexts. Acquiring private companies and assessing stock price of public companies are just two. MBA programs teach a variety of approaches to help in company valuation, including discounted cash flows. The problem is that these techniques require both detailed historical financials as well as pretty accurate future financials, not to mention an agreed upon reasonable discount rate. None of those are available for early stage companies. And so most early stage investors throw out the MBA techniques to valuation and use one of several different techniques. Unfortunately, there is no single common method, so what I'd like to do now is share 3 methods that I've seen used in different contexts. First, in the US, angel investors are taught a variation of what might be called a risk-adjusted valuation method. Second, venture capitalists will sometimes use what might be called a risk-adjusted ideal outcome approach to valuation. And finally, comparables are used, comparable companies and comparable financings, just like in real estate. I'll talk about comps in the second video. Before we dig into valuation methods, let's just take a minute to walk in financial investors' shoes. What are they trying to do? Well, they're trying to get at least 10 times return on their money with the enterprise value growing 50 to 100% compounding for 5 to 10 years. This is the way that they make sure that the potential returns are in line with risks for early stage companies. And they want to make sure that their portfolio companies are going to be able to raise future financing rounds at a higher price. So why is this important? Well, professional investors in turn get their money from other investors, and so they want to show those investors that they are making great deals, and that's especially important when they're getting ready to raise yet another round of venture capital. So overall, this means that they want to make sure that they are not paying above market what their peers, their competitors, are also willing to pay. The first approaches to valuation are all variations on a theme. These are techniques that have been taught to angel investors in the US. The first is the Dave Berkus method. You can figure out who developed that, and it assigns a value of up to $500,000 in each of 5 categories and how well the company's doing according to the angel investor, of course. First of all, is there a sound idea? Then, is there a prototype that's been already developed? Is there a quality team that's pretty close to being fully developed? Is there a quality board of directors? And finally, have there been initial sales to customers? And of course, these correspond to risks. So business model risk, product development risk, execution risk, governance, and marketing risk. So all of these then add up to a maximum of $2.5 million. That's the most he wants to pay. And for many years, about $2 million was the middle of the range for pre-money valuations for U.S. angel investors. So if Dave Berkus was looking at your company, what do you think your value would be? Another angel investor, Bill Payne, has 6 factors that you can see here, but he's assigned weights to them. So you can see that management actually has 3 times the weight of product or sales channel or how far along the business is. And each of these factors is given a plus or minus, a percentage, 100% plus or minus. And as you can see here, there are comments to justify that plus or minus. So, for example, what's interesting to see here is that in the eyes of this angel investor, a management team that's all there except for the salesperson gets 125%. But on the other hand, sales all being outside of the US actually ends up being negative. Now, all of these numbers boil down to a multiplier that is then multiplied against the baseline valuation of 1.75 million pre-money. Again, that's relatively close to where US angel valuations used to be. They're a little bit higher now. And then that all gets multiplied and turns into a very precise number. I should note, though, that because this is all very subjective, I'm guessing that when the term sheet for this company came out, it probably said just 1.9 million pre-money valuation without those other digits. The final valuation method taught to U.S. investors is a bit of a hybrid of the first two. There are now 12 factors to consider, and then the assessment plus or minus in this case is plus or minus $500,000 based again on the judgment of the angel investor about where you are. All of these pluses and minuses then add up to a number which is then added to that magic $1.75 million pre-money valuation. The example company in this case gets a $2 million valuation, and the same company using the Bill Payne method would get a $1.9 million valuation. So in theory, at least, these methodologies are supposed to be relatively close to each other. But I'm sure you've noticed that these are subjective. It is a judgment call by investors as to where you are. But I hope you do see that, in fact, investors are looking at various elements of your business, assessing where you are versus other companies that they've also seen, and then adjusting the value that is typical for your kind of company in your market based on their assessment of where you are relative to those other companies. I'm going to conclude this video with a technique I've seen some VCs use, and props to Leo Polovets of Sousa Ventures for sharing this technique in a much longer presentation. I will share a link to that presentation separately. So the basic math is that the value is the ideal outcome, that is to say, what you might expect in a best case scenario, times the chance to win, times some discount for the time value of money. So to take a simple example, imagine a $1 billion unicorn exit. Woohoo! But you multiply that times a 1% chance to win, and you end up with a expected value in the future of $10 million. Now then, that $10 million is then further reduced by a 20-ish annual time value of money to bring the seed value of the investment down to a $3 million number. The math may be different, but the risk assessment is similar to the techniques that I've just been talking about. In all cases, the investors are making an assessment of the critical risk factors, things that your company has to do in order to be successful, and making an assessment of the risk of those happening or not. So I'm going to share an example using this technique of 4 big risk factors, and in this case, the probability that the company is going to win is relatively low because it's young and it's very early stage. And so when you multiply these cumulative risks, you can see that, oh my goodness, you're already down to a 1% chance to win. Now, Obviously, you can play around with the math. You can increase the number of factors and plus or minus the particular risk factors. But I hope that you can see that your $1 billion potential is not going to get anywhere near that valuation when you are young and still have lots and lots of high risks in front of you.